good to have you all for the March Masterclass. As you can see, we're online. It's a great time to be alive and to be uh, excited online. We have Jason here with us. I'm going to introduce in a couple of minutes. He is fabulous. I'll tell you that much. Hey, during our prep call, we had some great info, some lovely tips already from this weekend. He's going to be here to answer all your. So he's giving us an hour of his time. So bombard, please. Like, give him as much of the question as you can. He's a senior leader, and he's very, very happy to answer a lot of our questions. So please put him in the hot spot. This is the time to do it. We're excited again. We started master classes in January, and it's been successful so far. And you asked for unstacking your chips at this time period, and it's a good opportunity, even if you're looking for this lens, right, to do this. So have all of you on here. I think there's some comment really about the sound. We're working on ensuring that that's gonna come in as well as possible. Please let us know, on the chat box if you are not hearing us. Same thing for the video. Please let us know if you're not hearing us very well, and I would work on that on our end. As you know, this is the time that we're trying to do an online version of this. Typically, I would like to go in a nice big setup as well. So we're working on the audio, and we'll get started with session. If you can please ask questions via an A box. I can ask those questions to just go along, on this. And Jason, why don't we get it kicked off by you providing us with your background? Like, how did you start? And what are you currently doing now?
Sure thing. I'll speak a little slow to start, just because I heard the audio being choppy as well. So I hope we can all get through this. So my background, actually formally educated in health sciences. I was going to start out a practitioner and be kind of an athletic doctor. Started at the university of health sciences, and that was the path I was on until I got introduced to the stock market and investing in teens around 20-ish or so. I started taking out stacks of books, reading up because I at the time, because the way you could learn anything about it was to go and actually get books. The advantage of having information at fingertips now. I did that along that path. I did my MBA, I did my CFA, worked in institutional equities and derivatives, worked with hedge funds, also worked with boutique dealers in Canada, where we were very focused on. Well, I've been around for a while and been through a number of markets and cycles that we go through, and have had exposure to a lot of different sectors. All of it's been mainly public equities, and there's been some where we've played in the private space has been kind of one before going public. So we're involved in a lot of reverse takeover transactions and new listings, effectively. That's kind of the in a nutshell, my background and how I got to where I am today.
Awesome. Thanks for that. I have a quick question for you here, Jason, and it's really simple. If you have an unlimited supply of one thing for the rest of your life, what would that be and why?
In terms of one thing for what exactly are you getting at in terms of one thing? Are you talking about looking at one specific indicator, or what exactly are you referring to?
Yeah, no, so it could be, a limited supply of time, of funds, basically, if you were to have an unlimited supply of one thing for the rest of your life, think of it as an icebreaker. What would it be, and why would you be choosing that?
I probably, because that's the only thing that nobody can get more of. So that would be the one thing that I'd want more of. It's just, no matter how many hours are in the day, you always feel that there's never enough hours in the day, unfortunately.
Yeah.
We're all under that. That's something you can't create. Money can't buy with asking a thing that's in limited supply for everyone.
Gotcha. Okay, we can, start before that. Please, folks, ask questions as we go through. I'll be taking on those questions and, passing them over to Jason. Jason, if you will, please get us started.
Needless to say, we're not giving any financial advice, and we're not making any recommendations for today. So when thinking about investing and about the marketplace, I've been reading a ton of stories. I'm glued to the screen since mid-February, when this all started to kind of really hit North America in the pandemic. And it's very clear that there's quite a big divide. And what this pandemic is really exposing is the kind of old adage rules, right? So this is a bit more high level. Before you get into investing, you got to really take into where you are with your life. I like to think about it as a bit hierarchy in terms of what you have to protect first. And number one are protecting your own personal assets, which is your health and your family. Without your own health, you're really not good to yourself or to anyone else, because there's nothing you can do, and no money can. The ability to have a good, healthy environment that you're living in, and to be healthy, and so that of your family. So, secondly, you don't want to be in the market with money that you really can't afford to spend. So you have to take a look at your financial assets, and there's tons of different modalities and thoughts about what to do. But I was quite surprised by the fact that, in a lot of cases, particularly at the lower rung, people barely even have 3 weeks of savings. I mean, for people to be in an utter panic and not have at least several months of savings set aside for a rainy day, exactly for situations like if you get a divorce, if you lose your job, if you're forced to sell certain assets. You have to have liquid assets that are sitting there that you can take and actually live your life with. And starting out with those two things, I think, is most important, and that brings you stability, at least on the home front. Because then you can take care if there's of expenses, if there's a family emergency, and if healthy and willing and able, then you're always going to have the ability to work and make more money. So now you get to the point of, if there is money left over, that's when you can start to look at investing in the market. Now, there's been a lot of talk also. I guess the key term right now, everybody's using as a buzzword, is mindfulness. A decade or so, personal development and it's had a number of different iterations. But at the end of the day, it's about getting to know yourself, getting to know your triggers, what works, what doesn't work, what you're comfortable with, what makes you not sleep at night. You really have to profile yourself. So as there's a financial number involved, and all kinds of there's all kinds of data involved in investing. What's less focused on is the psychological part of investing. It's really profiling yourself, understanding what all these factors are about yourself and where you fit in. We've got probably 3 different buckets of age groups, kind of on a sub 25 25 to 35 or 40. Then you might have some folks that are 40 to 55. It's got different things that they're thinking about. The latter just talked about the 40 to 55 group. They're really further along in their life. They're probably going to have a bit lower risk tolerance. The reality of retirement is probably really hitting them in the face when you're 24, 25. I don't know what where you're going to be when you're 65 or 70, but you should be. You should think about it now. And the reason that is the effects of compounding. You've got a much longer time horizon if you're sub 25 than somebody who's 55 to go through swings like this in the market and still come out ahead. You've got the whole multiplication of compounding your returns or compound interest that, if you're investing at, I think, about 7 or 8% a year, you'll be doubling your money every seven years. There's something called the rule of 72. So you take number 72, divide it by what you expect to return, and that'll tell you how many years it takes for you to double your money. So, when you do that and you've got an extra, 2 or 3 extra doubling periods because you're starting your investing earlier rather than later, that's a significant impact on the back end in those later years. So, these are all things that you have to go through to really understand yourself, understand, if something like this happens, you wake up the next day and you're down 30% in a month, are you going to sell? Or do you say to yourself, I've got another 20 years. I don't need this money now because I've already taken care of myself. Cash set aside. I'm not forced to sell. These are all factors that have to go into think about how you think of yourself and where you're going to fit in the entire investment universe. There's a lot of good online tools to do that, and there's a lot of good information on that online. So now, really, what I'll dive into now is that just from the perspective of understanding what's happening in the marketplace, is that you have to be a student of history to gain some perspective. Say that what's happened over the past decade is had a narrowing of attention span, a narrowing of depth of understanding. Hence, everybody's tend to react more and more headlines, and you're an inch deep and a mile wide in terms of your knowledge, and that's a problem because the data that's was coming out on, like if we take for example the virus, the data that was coming out or has been coming out, I would say kind of February, early March, is a lot different than the data that's been coming out lately. And I'm talking about the data I'm talking about the news headlines that are getting reported. I saw a big change last week where you're finally starting to see the media compile a lot of the data into their sound bites, as I was saying, into their kind of headline, very, you can digest these things in 5 minutes, where you actually have good summaries of what's happening in the marketplace and what the crisis means, what the virus does, etc. A lot of this data had been available in February, but it would require to do some deeper read, right? Actually read through some research articles, read through some other analyses of what's been going on. So, unless you did that and you just kind of read the headlines and relied on mainstream media to educate you on what's happening, you're not getting the full picture. And that happens more and more these days. So it's really important to be critical of your sources and to make sure that you're digging deep in terms of having a better understanding of how everything plays out into a certain context. I'll have later of gaining perspective that I'll go through as well. And one thing I want to recognize as well is part of this whole kind of getting to know yourself approach. You have what you react to and what you're biased, and ultimately influencing your decision process. So part of that is, like I was saying, really getting down to the nuts and bolts of how you tick and you react to. So, that's some kind of homework that you have to do. Also, you have to think about what lens are you looking things through, right? So if you think about a stock, if you're going to buy a stock, somebody else is selling stuff. So what would be motivating them to sell? What would be motivating you to buy? If you can put yourself in another person's shoes, well, it'll give you a bit more perspective on what it is that's going on. And the biggest thing I can say in all of this is really to tune out the noise. There's way too many distractions. It's very difficult to filter out information, and the better you have, the more you can filter out information that is not going to help your cause. That kind of goes with everything. If you know where you're going, then it's easier to allow the you need to actually come into your decision-making process. And there's a lot of scientific research about those types of biases out there as well. So in the context of gaining perspective, the market, I believe as of Monday was down, we were down well over 30% at one point, and now we're seeing a pretty big rally in the last couple of days. I think we're up a little over 15, 16, 17% if you're looking just at the S&P from the lows on Monday. But in that, you can see there's a pretty vast difference in the performance depending on the sector. And you can see that this is ranked by year-to-date performance. I've ranked them. So anything that's technology related has been performing generally better. Consumer staples, for those of you that don't know what consumer staples are, those are the things that people need each and every day. Toilet paper would be a good example if, butter, your food, that type of thing. Consumer discretionary is much further down the list. That's all any luxury goods or any, things that you don't need on a regular basis. But you can see there's a pretty wide discrepancy of what's going on. And down at the bottom of the list is energy. And the reason energy is off as much as it is, twofold. One is the slowdown from the coronavirus. But second, and more importantly, is there's a bit of a price war going on between Russia and Saudi Arabia at the moment. So, Saudis are the largest producer. They've got the lowest cost, and they're very sensitive to being kind of the global leader in OPEC. And they are looking at this as an opportunity to put some of the high-cost production out of business. And where's the high-cost production for oil and gas? Most of it's in North America, oil sands. So this is kind of their opportunity to move on that. And they were a bit peeved at the fact that Russia didn't cooperate with them on the production cuts. So they kind of said, well, we're the big dog on the street. It's not you guys, Russia. We're going to show you what low oil prices are about, and we'll see how long you're going to not play ball with us. So that's kind of what's going on. That's a bit harder to call, but even a big nation like that can stand low oil prices for a sustained period of time. It's going to really skew their budget, most of their budget coming from energy.
Jason, I'm going to butt in here pretty quickly. Regarding information, because you just mentioned about the price wars going on, and you also mentioned a couple of slides before about ensuring that you're filtering out the noise. Not relying on mainstream media is not going to be easy because that's what most of us are bombarded with. What kind of sources would you recommend in terms of, consuming consuming information that would be critical to good investing?
There's so many different sources right now. You know, this is almost where you have to, with any you have to get to know the journalists that are out there that publish good work. You'd have to get to start to see, you know, follow people on Twitter out kind of reliable, credible information, like not tweeting something that they haven't sat down and thought of. You know, there's a lot of sources. It's getting to know those sources, and I can share with you later on some of the sources of it that we look at.
Sounds good. Sounds good. And folks, once Jason sends that over, that will be something that we're gonna put in a recap communique that would send out across, as well as a recording of this session, and the slides that we're using, just so that you can also consume this information on your own. Jason, as you were going along as well, there was a lot of questions coming in of various forms, and just summarizing some of them in here. You talked about risk appetite, at the beginning as well, and folks are trying to understand, based on their own risk appetite. Some of them had a riskier appetite, going into the market crash, and now they're thinking about what should I do in terms of reevaluating how I think about what my risk appetite should look like. Should they stay super risky? Should they realign? Can you provide some suggestions as to what folks who were, on the more risky end of the spectrum should do now that the market's sort of rebalancing itself?
Well, I just changed to a headset here, so let me know if that's better or worse. Well, I'll continue, and then you can.
That sounds a lot better, actually.
Okay, great. Okay, sorry guys. Before. So risk. Okay, so there's this ominous word risk. What does it mean? How do you define it? Where do you see it? All these issues. The definitions. The way that I look at risk and the way that we look at it is we kind of take a look and say, okay, I'm going to enter a certain order on a stock. Now, if I'm wrong on the stock, I think, let's just say it's a $10 stock. If I'm wrong, I think the stock will go to $9, right? So I don't want to lose more than $5,000 on this trade. So I'll take the 5,000, divide that by the $1, and that'll get me where that'll back into the number of shares that I need to buy, which would be 5,000 shares of that stock. Because I know if it goes down $1, that's my stop loss. I'm going to sell it. And that's the best way that we found to define risk and program risk into the mix. So it's less about the specific sectors or what you're looking to invest in. It's really, how do you manage your capital? Like if you have 10,000 or 100,000 or $1 million, you don't want to be in a situation, or at least we wouldn't look to a situation where we're putting, all our eggs in one basket, or, just spreading that through, 2 or 3 stocks, because that to us is risky, because there's the concept of geometric returns. So beyond a 10% loss, I believe the number is, you lose 10%, you need about 11% move to get it back. And then the numbers start to get worse from there, so that if you have a, let me just see if I've got it here beside me. If you've got a 50% down move, let's say you lose 50% of your money on a stock, that stock has to go up now 100% for you to break even. So there's a very defined mathematical, stop loss of kind of less than 8 to 10% that you want to make sure that you're not going to, go beyond that in terms of a downdraft. So that's kind of how we think about risk. So in terms of the sectors that are going to be riskier now, I think that question more relates to leverage. Where can I get my most bang for my buck if I'm right? You're definitely going to look at the energy sector. You're going to look at companies that are highly levered. that are really exposed to this business because they've been beaten up the most, right? You're going to look at airlines, hotels, casinos, movie theaters, those types of areas, right? Because that's where the lockdown is really going to crimp business in a big way. And generally, those businesses carry a lot of debt. So what happens is, Air Canada is down from $50 to, I think I got a slide of Air Canada here, actually. Yeah, I've got Air Canada right here. So Air Canada is down from $50 to $12. That's what leverage does.
Yeah, that's a very good explanation. Yeah, and just folks, just because some people are re-asking the question, the webinar is being recorded and would be sent out in a couple of days by the BPTN team, as well as some of the sources that Jason is going to be providing in terms of where, information sources that are typically good to go by in terms of advising you about understanding what the market is saying regarding your places of interest. Something else, Jason, that I wanted to bring up before we sort of jump back on is, from a riskier standpoint, the question's coming up more and more now. Do I personally invest by myself, or do I put my money into, say, an ETF that's a dividend growth fund or dividend growth portfolio, for example? So literally what the question is between, do I go continuously looking for information by myself and actively investing by myself, or do I go with a financial advisor or a robo-advisor or something of that nature?
That again is going back to figuring out your profile. Okay, I had a call every morning, and somebody was asking me, which brokerage account should I open up? And I know the individual said, listen, you're gonna trade a stock like 2 or 3 times a year, so you're gonna be you're not going to really pay attention to it, so you're best off probably going to be in something that you don't need to pay attention to, right? And then you have to figure out your risk tolerance. You might say, well, I want to buy an equity fund, which is much higher risk than buying a bond fund, but I really don't want to pay attention to it. So it all really comes down to your risk profile. We've got the opposite end of the spectrum where there's folks probably on this forum that want to have a high degree of oversight in terms of what they're doing, and they want to be much more active traders and on top of things. And that's where you can lean towards more investing in single stocks or options or whatever it may be.
Gotcha. Okay, please let's carry along.
So just getting back to gaining perspective, just to flip through a couple more slides here. So here's a long-term chart of oil all the way back to 1990. Okay, at one point oil was like $5 a barrel. That's kind of when I started in the business here in '99. We've seen 3 lower lows. We saw 2008, 2009, sub 40, around 35 we bottomed out. And we bottomed out at around 27, 28 in 2016. And now, we don't know if we bottomed out yet, but we've basically hit around $20. All of North America's oil production virtually is not economic at this level. And that's partly the reason why, there's a price war going on. But what I want, as opposed to getting into the fundamentals of each of these different things, just understand there are sectors that are performing, right? If we look at the S&P versus gold, gold's actually up on the year, even though the index is down 30%. So gold's doing what it's supposed to be doing in times of panic as a hedge. And then another way to gain some perspective is, as I mentioned before, as of Monday, we were down over 30%. So if you look at this, how many instances in the last 93 years has the market actually closed down more than 30%? 3. This would be the 4th time if it closed down that much this year. So you have to put all these things into context. But now if we look at periods of bear markets, which would be my next slide, the red line is kind of our trajectory right now. So this is the fastest downdraft that we've had if you look at all the bear markets in history. Are we the worst bear market? No, not yet. I mean, there's bear markets that have continued on. So the bottom of the graph tells you how many days since the bear market started. And a bear market's defined as a 20% drop in the index from its peak. So it's kind of backward looking, right? You don't know you're in a bear market till you're in a bear market. So when the index drops 20% and stays below 20% from its recent peak, that's defined as a bear market, and that can last for years. This period's unique in that it's the fastest, but it is not yet anywhere near the greatest. And that's what this chart is trying to illustrate here. But you also have to recognize here that we are at pretty extreme levels. This is called the Vix Indicator. It basically measures the level of fear in the market. It's a proxy for that. And the last time we had readings this high was in the 08-09 crash, and then the tech wreck in 2000 to 2002. Those are the last times. So we are kind of at panic levels that, as we were saying before, these things can continue. Chaos doesn't mean total disorder. But this is, I put up this quote just so that people understand that in chaos, there's opportunity, right? And if you're in the right mindset, which gets back to doing all that self-work and cutting out the noise so that you can actually be focused on looking for opportunities, then you can actually start to look for that. Because there's a lot of just kind of, people get very deflated and basically bummed out by what's happening in the market, and everybody feels better when the entire market's doing better. But you don't need the market to be doing better in order for you to find good opportunities. So, I mean, here's an example. How many people have looked up the stock price of Zoom lately? We're on a Zoom call. It's breaking out to new highs. Could it be that all the people having to stay home get on Zoom calls is going to be good for their business? You bet, right? So, and I'm not suggesting, hey, go out and buy Zoom right now just because, this stock needs to set up again. The correct time would have been to buy it back here in February, and then you had another shot here literally like last week. You had a shot for kind of a breakout trading strategy to buy it. But fundamentally speaking, this should have a trajectory that kind of continues to grow. Now that, given what's going on, people are going to want to be set up remotely. Companies are going to want to be set up remotely. Slack the other day, which I don't have a chart for Slack, but ticker symbol is WORK. They saw in February, they added 9,000 new customers. And that's more than or equivalent to what they added in all of Q3 and 4 last year. So their growth in 1 month is almost the same amount as what they grew in 6 months last year, because companies are, again, setting up the ability to work virtually. Here's another opportunity that came up. Telemedicine. People need online doctors. They don't want to go to a doctor's office with a shutdown. So some of these things react to the news, and some of these moves are for sure very much news driven. But you can bet that this is the time to also, depending on how long this is extended, these companies see a fundamental change in their business in terms of an uptick of users and revenue and that type of thing. And then there's the flip side. If we're thinking about going, you don't always have to buy stocks to make money. You can short stocks, which means you're betting on the price of stocks going down. Okay. So here are a couple good examples of bets that you could have made. So Cineplex this is a bit of a unique situation. I mean, Cineplex, the movie theaters, everybody's gone to a movie at some point. We've got a monopoly here in Canada because it's virtually, they're the largest and really the only, they're the lion's share of the movie theaters here. But they were getting taken out. That's why this stock is a flat line up here at around $34. They were getting taken out, $34 all cash. And I wish I had paid attention to this before, because we would have put this on. But if you started to think about lockdowns and people talking about lockdowns and stuff, oh, you're going to lock down. Is going to the movies an essential business? No. Or essential service? No. So notwithstanding they're getting bought by somebody else, look what happened to the stock, right? Because everybody panicked as soon as the actual lockdowns hit. But there was a time here for a couple days, more than enough time to see there's something going wrong with this deal. And what's your worst? You shorted it at 32 and the deal closes at 34, so you lose $2 on the trade. You just, again, you risk it. You would have bought, say you're risking $5,000, $2 downside. So, you would have traded, a little over 2,500 shares. Right?
Mm-hmm.
But your upside would have been huge if it went to 20 or 15 if the deal broke. That's an example of one. And
what about the
seeing airline? Pardon me?
What about the possible downside to that? There was a question about explaining the dangers of shorting stocks, just as you can also explain the possibilities of wealth from shorting them.
Well, when you short, you have an unlimited risk, right? Because a stock can go from $10 to $100. With Cineplex specifically, they are being bought out. So another company's buying them at $34 a share. That's why if you look back December 16th, you see the stock jump from 25 to 34 and it's stayed flat because they're getting bought by somebody else. So nobody's going to pay more for a business after they've already announced a deal like this. So in this is a very unique case that it's almost the perfect short because your downside is fixed because there's a buyout at 34, and the upside is the buyout. The worst case is the buyout doesn't happen and the stock breaks, right? Like the $34 bid goes away, and you would think that the shares fall back to where they were before it got bid, but in this case they fell substantially more. And for clarity, this deal hasn't even broke yet. They're still going forward with the deal. There's risk that the deal doesn't go through at 34. But now down at these levels, if I had a longer chart here, I'd show you that this is basically the same price as it was in 2003 when it got down to around $8-9. That's the 2000. So on the flip side, if you wanted to make a bet and say, hey, movies are a monopoly in Canada, they're probably not going to go out of business. As soon as they reopen, people are going to keep going to the movies. Then, I can take on a little bit of this here.
Right. So is it too late, for folks who are looking at this and looking at this chart and having this, oh wow, amazing, I lost so much time. I should have been charting since February, since January. Would you say it's too late now, or would you say we're still in some sort of an opportunistic time period?
Oh, we're in a very opportunistic time period because I don't think we're not out of the woods yet. And actually, let me show you what. Here are some previous corrections that 2008 to 2016, and you can see the how much the markets fell along the top and how long the period was. So the difference is the pink is an actual bear market, and the light blue or purple are corrections. So corrections are market drops of less than 20%, and bear markets are drops of greater than 20%. So, these things usually stick around for a little while. So there's going to be a lot of back and forth. And that's where, those opportunities come from. Right now, if we take a look at this here, what this shows you, the orange at the bottom, you see in the bottom right-hand corner, is a little 2.5%. That means 2.5% of the stocks in the index are above the 50-day moving average. That's a very, very extreme measure, but that just shows you the severity of the sell-off. And what this entire chart shows you, that the little arrows on the chart say, hey, when 90% of the stocks in the index are above their 50-day moving average, this is what the stock market does afterwards. And you can see in virtually, I think, pretty much every up arrow, when you get 90% of the stocks above the 50-day, the market moves up and continues to move up beyond that, some longer periods than others. But there's not one instance here where the market moves down after you get that coming out of a recovery. So what this suggests is We're at 2.5% above the 50-day now. So if we want to get long and just buy the market and be more confident that things are going to continue going and this isn't a false rally, we need to wait till 90%, another 87.5% of the stocks come back above the 50-day. And that would be a signal for you. But this is where, see, when you actually look at some and this is why I say gain perspective, right? I haven't shown you one news release. I haven't shown you one media clip, because all that stuff is noise. This is where you have to take a 10,000-foot view, recognize there's dozens and decades of history that you can actually dig in and go, okay, you know what? What did the market do? How does the market act in these times? Because, you know, trying to do something with the market just based on headlines and what's going on, it's very, very difficult.
Yeah,
and then,
yeah, totally understood.
The other thing, and this is a big kind of topic that is coming up, you know, inflation, what does it mean? Things are getting more expensive, and there's risks to not being invested, right? Because your security, your future security, and inflation eroding your gains. I mean, you know, there are those that have high enough paying jobs that they're going to be able to put away, you know, some money and do that over a number of years. But we're not in that environment like it was in the, you know, 50s, 60s, even 70s, where companies took care of their employees, where you had pension plans that basically would pay a fixed amount for until you die. Like, we're not in that universe anymore, right? Everybody's kind of responsible for their own retirement. And, you know, this is why, you know, the younger folks in particular, you got to start saving now. You got to start saving now and investing now, because you need that time horizon. You know, CPP or old age pension or any of these things, that you're not going to be able to live off of that. And personally, in my opinion, you know, so there's a big risk to not being invested. But this is why you have to take this part of the thing seriously. So, you know, when we're looking at the market right now,
before you go ahead a little bit more, just wanted to let the folks know that we will be going 5 minutes over, just because we had some technical difficulties starting the call. So we apologize for that. We're very happy, because once the call went on pretty well in the audio section, all the questions started firing off. So we're going to try our best to answer as much questions as we can. So folks, we're going to go 5 minutes over the time limit. So we're going to pause the call at 1:05 as opposed to 1 p.m. just so Jason can go through his entire presentation and we can ask more questions. Over to you,
I'll just clean it up here quickly. So if you want low risk opportunities, don't buy any companies that have debt. You got to buy businesses that can that are kind of essential, that can withstand a slowdown. The other way to invest is if you can find debt securities on stocks that you like a convertible debenture or some kind of secured debenture. You know, some of these are going to be trading at 70, 60, 50 cents on the dollar. And you're higher in the capital structure, because the equity holder is last. If the company goes bankrupt, the equity goes to zero, and then the debt holders are the ones that own the company. So you can actually get something back. So that's a good area to look at. And then the other area, if you can find good companies that have businesses that are trading at or near their cash value, then that's usually pretty, you know, if you can sit and wait and they don't have to spend that cash on building anything, then they can kind of wait for the upturn, and you've managed your risk that way. Because right now the issue is companies that have a lot of debt, like, you know, like look at the airlines, Bombardier, Boeing, all these guys. Like, with any kind of slowdown, like look what's happening to real estate and REITs. Same thing. These guys have a lot of debt, and like right away, a bunch of rental properties have been listed already, because these guys, you know, like they know the renter can't make the payment, and the owner doesn't want to start losing money, so he just wants to flip out the house, right? So that there's stuff like that that's going on. So just in quick summary, I know we covered up a lot. You got to take responsibility. Because I saw some guy had posted something saying that he looked at his TD account, he hadn't looked at it for 10 years, and now his money's missing, and he's trying to blame the bank and all this stuff. If you have money in the bank, you should be checking it on a monthly basis. It's kind of your responsibility. I'm sorry, but it's not the kind of universe you live in where you can just expect things to kind of be there. You have to check and know where your money is, and take responsibility to educate yourself and be on top of what because this is your life. It's your personal investments. It's your life. You got to take responsibility. Don't blame anybody else. Figure out your risk tolerance, your profile, what triggers you in a positive way or negative way, what your biases are, how you look at things. Figure all that stuff out, because that's gonna help. Market perspective, you got to gain. Read history, study, look at the big picture on what's happening. And a lot of the stuff's very logical and intuitive, you'll find. And then start to take advantage of opportunities. So that's kind of in summary of everything. And
in terms of taking opportunities as they come, one question that we've had a fair amount of times is, do you have any suggestions for possibly free or low-cost online trading platforms for first-time investors? And keeping in mind, folks, that, even though we're almost at the end of the call here, you can still ask your questions. We're still going to try to get them answered. We've had, successfully over 200 folks on the call even till now. So there's a lot of engagement, and, please feel free to, hashtag BPTN on your socials, just so that everyone can also participate on this, retroactively, even though you are participating on it, live. So going back to the question there, Jason, do you have any suggestions overall for first-time investors? One, what kind of platforms should they familiarize themselves with, and what kind of information should they use, and just how much do you need to get started?
Well, number one, so if you're just gonna buy some mutual funds or some indexes, and if you're gonna be kind of more the buy and hold investor, I would say just make your life easy. Open up the brokerage account with your bank. Don't worry about if it's $9.99 a trade, or you can get like $2.99 a trade somewhere else. You're going to be making 4 trades a year. Like, it doesn't matter. Just make it easy for yourself. If you're going to be a more active trader, then you want to look at some. You have to take a look at what tools do they give you for what you're paying for, right? Interactive brokers is a good one to look at. Scotia iTrade is quite good. I've used both of the platforms. Questrade, I haven't used that, but I've heard good things about. Those are kind of the key kind of low cost, or Questrade and interactive brokers. But now some of them, like if you're trading small cap penny stocks in Canada, some of those platforms might actually be more expensive. So it also depends on what you trade. But then you also have to take a look at what systems do you get, like what portfolio analysis, charting, all those things kind of factor into it. So, unless you know what you're going to be using it for, I would say figure out what you're going to be using it for, and then do the analysis of what you get, because you do get what you kind of pay for.
Mm-hmm. Yeah, so we keep getting more and more questions about tool specifics, in terms of tools like Wealthsimple, Questrade, and the like. Again, to Jason's point there, understanding what kind of trader you would be, what kind of investor you would be, is going to define what platforms you want to take advantage of. Just going to pivot a little bit here, Jason. Stop limit prices are not something that we've touched on as much. Would you just, give us a few nuggets about how proactive you want to be or not in terms of setting up, stop limits for yourself if you're going to be active in terms of trading? Well,
okay. So, stop limits need to be taken in the context of what your strategy is. So let me contrast 2 different strategies. Okay. And let me try to pull up a chart. Okay. So, let's just take a look at the Air Canada here, right? If I am a swing trader, I'm looking for extreme moves in the market, and I'll use some technicals like maybe RSI, like a lot of people use RSI. It's at the top of the Air Canada chart here, right? They might say, personally, I don't like RSI 14 in the top left. I like RSI 8. And we hit an RSI 8 under 10. It's RSI is relative strength index. So if we look at this, does my pointer show up on the screen or no?
The pointer doesn't show up as
okay. Well, if you look at the Air Canada chart on the right hand side, around March the 16th, 17th, 18th, you'll see a big drop there. And if you look above, you can see the shaded red area hits around 10. Okay, that's where I would start to look at a stock for a swing trade. And what I'm looking for is extreme moves like that with that indicator to buy or to sell, right? So that's and then doing a stop loss in that scenario is going to be a lot different than doing a stop loss on more of a breakout trade where if I look at Teledoc, the setup would have been here on, if you look at 2020 and then you see the number 13, so it's January 13th, you see the big spike up in volume, stock clears a brand new high, and I'd probably be buying somewhere in there at try to buy at half that bar, and then I'd look at a stop of 8%, and then I'd trail my stop up from that, and my stop would probably be the blue line. Once we got in the money, then my stop would be the blue line. So I'm actually, if I had done that trade, I would have not got stopped out yet because we haven't had a close below that blue line. But it's quite, you're looking at things quite differently. So again, it comes down to what strategy are you trading, and how much risk you can take on. We have some positions that we believe in longer term that are more, we need the story to unfold like it's a gold exploration company. So in that case, I'm buying those at or near cash value with exploration, and I'm not really putting a stop in there because there's been enough sniffs of the results that we're looking for, and we know the market will react to more and more results, and there's a high likelihood that they'll hit their results. And then we also bought it on a swing trade in addition to that, so then we're up money in that pretty quickly. But yeah, generally stops because of the geometric issue that I explained before. If you're down 10, you need to go up 11 to break even. But if you're down 50, you need to go up 100. So in general, you want to keep those tight in that kind of less than 10% range. And there's a lot I can if you want to look at breakout trading, you look up a gentleman by the name of Mark Minervini. He's very good. He summarizes a bunch of other traders, Stan Weinstein, William O'Neill, and these guys are breakout traders. They have systems for that. And if you ever want to see the resources that we use and follow, if you look at my Twitter, you'll see the folks that I follow. Some are individuals, some are just fun stuff, and some of it are serious research. And you'll see some of the stuff that I'm tweeting and retweeting that I'm pretty critical when I look through things, and that's where you can find a list of kind of resources to look at.
Nice. What's your handle, Jason?
It's at PK Dale, so Paul Kite Dale, DALE.
Gotcha. Yeah. Folks, that's
I'm being told to tell the story. I'm being told. So I'm from Toronto. I grew up in Parkdale, and I love Parkdale. So that's why it's at PK Dale.
Gotcha. I'm gonna lump in a couple of questions into one here. There's the oil price wars going on. There's the green energy movement before we went into the dip, and probably still gonna continue. What would you say is going to be the outlook for folks who have some sort of asset in the energy sector? Are we looking at the beginning of a downturn, or in the next 5 years, the outlook is still going to remain the same?
I see. I think you're talking about, look, oil's green energy and batteries and electrification of everything. That's going to continue. And it's a slow decline for oil, right? it doesn't evaporate overnight. It's kind of a slow decline. But then you also have to recognize we're getting into higher and higher cost production for new reserves. So, oil doesn't trade below its marginal cost of production for very long. So you have kind of an offset. I mean, just recognize that, yes, green energy and all that's the future. When do we overtake oil? I don't know if that's 10 years from now or 30 years from now, where more stuff's green than carbon based. But somewhere there will probably be a crossover. But also recognize that every oil barrel you're trying to get out of the ground is more costly, and you've got to go further and further. So that's always supportive of the price as well.
Gotcha. In terms of another industry, and you mentioned it slightly, the real estate industry, depending on how long we go in terms of this downturn, what do you see in terms of an outlook there?
Well, there's some funny stuff going on in commercial real estate right now. I've been reading, and we've got some private real estate, nothing in the public sector, but there's some issues with credit seizing up on some of the commercial real estate. I think Cheesecake Factory, which is a restaurant chain in the US, came out and said, April 1st, we're not paying our landlords. So what's happening now is a lot of banks are trying to get off some of their commercial real estate exposure. And really, it's going to be about how quickly do people get back to work and they can start paying their rents again. How quickly do businesses get back to normal and they can start paying their rents. That's what I think. That's what I think is going to be one of the key factors. Specifically in Canada, the Canadian dollar is now around 70 cents, I think a little bit below. So we've lost a lot of value in the Canadian dollar, and foreigners have loved real estate in Canada because they get the sanctity of contract and security, but they don't have the same scrutiny as they have in the US if they're coming into the market here. So recognize that on a global basis, Canadian real estate just got cheaper, even at the same price, because the currency's moved. So I think that that's going to offset things. But the real factor is going to be, we're going to see how much spec was in the market here in terms of people buying rental units on leverage and not being able to afford those now, and what kind of an impact that's going to have. It's kind of too early to say. But the longer it drags out, the worse it'll start to get for real estate.
Right. Some speculative questions here around what has started as a health issue is basically dragging other parts of the market down, and it's beginning to make some more headlines in the electronic or digitization industry, specifically around cryptocurrencies. Is that something that, from a purely speculation, of course, standpoint, do you see that having a positive impact on digitization of money? We're not printing money anymore. We're constantly using it online, and possibly cryptocurrencies.
Yeah. Crypto, well, there's two different things. There's cryptocurrencies, and then there's the blockchain. So I think the blockchain has a lot of useful business applications, but it's kind of like having an operations guy. Like, it runs in the background and makes sure everything's running smoothly. And cryptocurrencies are it's another form of exchange, right? Means of exchange. People used to exchange goods. Then they figured out a paper money system, and now we figured out a currency system. So, there's kind of vested interests against widespread adoption of that, as we've seen through some of the regulation that's gone on. So I think it's going to be it's going to take a long time for it to become any type of mainstream currency that's being used, in my opinion. But it's going to have its place that people who are early adopters and believers are going to take it on. But whether it goes mainstream or not, there's got to be a lot of regulatory changes to facilitate that, because everything's been about kind of preventing it from moving forward.
Yeah, understood. We're just 2 minutes, or actually a minute, out of close here, folks. And, this recording and the slides and further information will be provided by the BPTN team for folks who have mentioned that they joined late or they want to share this with their brother who missed it because of a conflict. So don't worry about that. This information is canned and it's going to be shared because we had a lot of insights here. There were some questions that we were not able to, touch on, but some of them would also be baked into that information package that we're going to provide to all the attendees. So don't worry about your question not necessarily being answered at this point in time. Jason, wrapping this up, how much would you say it's important for us to monitor the news, because we don't know just how much more we're going to last in terms of the downturn? Is it going to be a U market shape? Is it going to be a V market shape? How much more important is it for folks to put their ears on the ground?
I think it's when I say tune out noise and tune out kind of the media is you have to take it in, but you have to take it in through a proper filter, which again, when you do the work on yourself and where your mindset is and where you want to go, then you can have a certain lens at which you take that information in through, and it doesn't necessarily cause you to react one way or another. You have a much more clarity, and then you're also more selective of which sources you. So I think it's important. I think this year is look. We had 08, we had 2000. Before that, we had 87. These are once in kind of a decade opportunities that you can take advantage of and make some real gains. So it's really important to monitor what's going on. Recognize, hey, we're not out of the woods yet, but somewhere likely this year, early, we're going to find a bottom, and things will gradually get better from there. But a lot of it is data dependent right now on how this pandemic plays out, how quickly people get back to work, etc. But the biggest thing is recognize the world's not ending, the world's not over. It's going to go, things are going to go back up again. It's just a matter of time when that happens. So now is not the time to throw in the towel. Now is the time to do the work and be ready to position yourself for the opportunities. If you're going to wait till, I'm going to wait till this whole thing blows over, then I'm going to look at the market. Market might be up, a lot of stocks might be up 100, 200% by then. And then you're going to say, well, now it's up too much. I'm going to wait for it to pull back and get in. And then you're never going to get in the market. And that's the risk you run.
Awesome. Thank you so much, Jason. Thanks everyone for joining this call. We will be back again next month. But we really appreciate your attendance for this, and wishing you the very best the rest of your day. # BPTN on all your socials for this, and we'll see you later. Thank you.